Good afternoon, everybody. Hello from New York City. I made it. I survived. Yeah, that's what happens when I spend too much time out west. The camera going on for the first time in a while. Maybe we can start making that a habit a little bit again. Some of these meetings. No, not Southwest. West, Idaho. It's in Idaho since January. I've been doing like half the year there, half the year in New York. It just happens, Brett. Oh man, Davey cracking me up. Cracking me up. It's an attempt at a more than just a mustache. I just, at my late 30s here, haven't fully gone through puberty yet, so I can't really get hair in certain spots. I get a little beard going on, little mustache action happening. Maybe someday I'll age enough to be able to grow a little more facial hair. But I think my wife likes it, so that's all that matters. All right, let's Varun. All right, let's hop into the meeting. Let's get this disclosure done. Oh my God, I can't even look at the VTF right now. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and a member of FINRA/SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There's the position disclosure. I seriously can't even look at the VTF with that meme that Bandit just posted. It's too funny. I got out of my TQQQ short today as per my game plan. I entered into an Alibaba long, and I kept some of it overnight. I got into and out of some pins today. I got into and out of some target today. And yeah, let's take a look at some markets. All right. So SPY's here closing down 0.6%. Q's closing down 0.75%. And IWM, you guessed it, disappointing and relatively weak once again, off 1.07%. So down more than the other indices. So we are not seeing the perfect bull case scenario. Dave, we are not seeing that perfect bull case scenario that we were looking for. The most ideal bull case that we had discussed, just hopping right over to some daily charts, is Q's resting, going sideways. I said between like 345 and 351 or so. Building out a flag here probably over the course of this entire week. The move was so big, it probably would need a full week of sideways price action to allow these moving averages to catch up. You want that to happen. That's healthy. You don't want to see a parabolic blow off top in this thing, which is kind of where we're starting to get to. But you want to see that with the IWM actually holding in and breadth improving a little bit. And we didn't get that. The IWM is still in this range. It's been in this range since we broke down from SVB in mid-March. So we've been in this range for 2.5 months now for the IWM, stuck between key levels of 170 support and 180 resistance. And again, what you want to see if you're super bullish is the Q's rest in this IWM catching up. You're not seeing that. We also don't have confirmation of what I would consider to be the super bearish scenario happening yet. That super bearish scenario would be that the Qs are a blow off top, that they pull all the way back in and erase the last part of this move. So I'll start getting pretty nervous if the Qs begin to lose 336.66, which is the low from May 25th. That would kill off this entire 3-day move that we recently had. And that would be in conjunction with the SPYs showing you a false breakout above that SPY 418 area, which is approximately SPX 4200. I would assume with where we close in the SPYs, we close like right at or possibly just below that key SPX 4200. I would not expect that to be like a perfect straight line support level. I do expect it to be sloppy, especially when we had some upside extension there that really just got satisfied today. So thus far, post Nvidia, which I feel like almost changed the world a little bit as far as this market goes. Thus far, post Nvidia, these last 3 trading sessions, we don't have the most bullish scenario yet, at least, and we certainly don't have the most bearish scenario yet, at least. So just still waiting to gather more information, waiting for these tech stocks, which had such big moves, to potentially reset up, waiting and watching to see if the S&P can continue to hold above 4,200, which has become such a key level for this market to hold above, and waiting and watching to see if this IWM is able to eventually clear out of this range, either up or down, to give us a little bit more clarity. So until then, our extension rules certainly apply for the Qs and these tech stocks, and it was a great, day and a half short to be shorting the Qs up at those highs. I know it worked really well for me. It was a great hedge that added a lot of cash flow to kind of my portfolio over the course of the last day and a half. I followed my game plan perfectly, where as these stocks were extending up and as the Qs were at $14 of extension from the ADMA, I was just piecing out of my longs and getting pretty light there, and then starting to build into that QQQ short basically at the same time. And all I'm looking for from that QQQ short, and maybe I end up looking back and seeing that I sold myself short by getting out today, but all I was really looking for is a technical correction of the extension. And that technical correction could be deeper. We could easily pull back to the ADMA on the daily chart with the Qs and have them still be healthy, which would be that 342 area. And it's into that area, into the space between the 8 and 21 EMA, that's where I would become particularly more interested in beginning to build back into some of these stocks that I have been selling on the way up. And that just goes back to, I think I did an afternoon meeting about it 2 weeks ago, back when we were still in the range. Of course, now, as soon as I did an afternoon meeting where I really discussed kind of game planning for range-bound markets, is when we finally started to break out a little bit. But I think that still applies. You get that big level of extension from that really big move. You're in an area where statistical probability of continuation becomes really low. You piece out of that. You buy back in. Say eyes all over the place, huh? You buy back in on the way down, and you're able to keep the cash flow difference. AI is up now from where we close. Interesting. It's sick. So that's kind of been the motivation for me with this market, has just been really kind of mixing portfolio management with cash flow day trading on some of these swing positions as they're giving me these bigger moves. And for me, at least, it's working out really well. Though it's interesting that on a lot of these days, like a day like today, for example, some of my swing positions are very much underperforming, and some of my swing positions are very much outperforming. And net, I still finished up pretty decently today. So that's kind of it. I guess we could take a quick look at the small picture. I was very excited off the open, and then that excitement dissipated, because you can look at the SPYs here in that first 5 minutes. You can look at the Qs here in the first 5 minutes. The Qs had an okay uptick in that first 5 minutes. But you look at the IWM, look at that first candle in the Russell. Huge red to green. And I was like, oh man, perfect. This is it. This is exactly what I want, is these Qs. Okay, fine, they're filling their gap a little bit. They're bouncing a little bit off the gap down. And we discussed this morning that gap downs in bullish markets tend to be viable, and you had a little bit of an opening move here in the Qs. You had an opening move in the IWM. SPYs were a little bit weaker before the ADMA caught up, and eventually it failed back down. But yeah, excitement for about 3.5 minutes this morning with the IWM just completely going. XBI's first candle was kind of insane. It's a huge candle, especially for it to then fail and come all the way down and make new lows. But eventually this market failed. We had that number hit. I almost can't even remember what that number was anymore. I know we had jolts come out at 10, and then what was the number that came out at 9:45? I really can't remember. I'm really losing it. But it was PMI at 9:45, right? So PMI came out, and it was the Chicago number, and it was like super light versus expectations, and that seemed like it really changed the market there at 9:45. The IWM, which was looking great for the first 10 minutes, even with that worse than like ever. The IWM, which was looking great for the first 10 minutes, and the Qs, fine, they were catching up a little bit. All of a sudden, it seemed like the Qs were becoming a safety trade again. And Apple, I remember watching Apple not caring at all about that number and being extremely strong, again, just like a safety trade, basically. And the IWM, which was acting really strong for that first 10 minutes or so, then entirely fading. That 950 bar was just brutal. And all of that hope and excitement that I kind of had, hope's a bad word to use in trading, so I got to be careful with that one. Don't trade based off of hope. Be careful with that. But the hope and excitement that I kind of had based on the strength I was seeing in the IWM was totally gone by 950. When the market was falling back down, it was falling down. The KRE was leading lower. This KRE was getting absolutely destroyed. We saw almost near the bottom, not quite at the bottom, a headline come out that the FDIC, I think, was adding on 4 banks. Maybe someone can remind me of that too. It's been a long day. Adding on several banks to their kind of watch list of banks that I guess they think maybe could be problematic or go insolvent, and that really helped deteriorate this KRE further. XLF was also really gross today. That helped the IWM stay weaker. XLE was weak off the open. Tried to be strong early on. Tried to hold that 76 level. It did hold that 76 level, which is key support, but it was never able to recapture 77. I was feeling a little excited around 1035 when we ticked above 77 again. Looked like maybe we'd go after highs, getting above these moving averages, just to fail back down. So that Chevron idea ended up being pretty difficult. So that Oxy idea, which I was not involved in, while it also gave that uptick, by the end of the day, it was kind of difficult as well. And yeah, that's pretty much it for me. You know, looking for that RDR on target. I took the trade. I got stopped out. It was a small winner for me. I never went back at it. Target now day 1, 2, 3, 4, 5. Day 6 to the downside, getting really extended. This is a very big move for a company such as Target. So looking for the RDR early on in the day today, basically on the first 5-minute bar. So I just put a buy stop at yesterday's low. Yesterday's low was 58 cents, 133.58. So I just had a buy stop at 153. 133.58, and it bought me in. I thought it was looking like maybe I was going to get stopped out at 9:45. It never broke that low. Caught this great uptick. I was able to sell some stock into this. I know I sold some stock around 135. I thought that there was a possibility of a move to these upper 130s. I was thinking that with the ADMA on the daily chart at basically 141, that catching a move to 138, 139 was very reasonable, and that's kind of what my target was. That's what I was looking for. But I did take a bigger sell at about 135. It came down, it started acting weak. It stopped me out at those lows, and I never went back to it. And I was able to, you know, make a little bit of money on it just by having a good game plan, even though the trade itself actually failed. Another one I got stopped out of today was UPRO, and I basically got stopped out at lows. I started nibbling into this UPRO. It's the same extension rules that I'm using, you know, pretty much all the time. You have this hammer come in. It's 10:25 a.m. You got extension, and this is, you know, just leverage SPYs, right? So I can look at the SPYs. You got a lot of extension here at 10:25 a.m. We're extended on a 5-minute chart, let alone how extended we are on a 15-minute chart. I know at this time of the day it becomes a very high probability of getting a correction through price or time. The bet, if you will, the risk reward is on a price correction. So I was able to be involved in that. I started really small. I did not get stopped out on this candle here when a new low came in. I actually even added more, and once I added more and caught this bounce, I had that stop loss in place, and I got stopped out here. I got stopped out at 11:30 or so when the new low came in, which actually turned out to be like a very small time frame double bottom. It is typical in double bottoms, and this is actually what helps the market go up, is that the second low is lower than the first low. And what that does is anyone that's long off this low, aka me, they get shaken out of their position. And now that people like me, honestly, are not going to be selling on the offer on the way up, it makes it even easier for your stock, or in this case the market itself, to actually go higher because those sellers were eliminated. So yeah, got pushed out of that U Pro, but that was another break even-ish type trade because this move was all I need to really make sure that I got my risk covered. And that's pretty much it. Exited T Triple Q for a pretty. This was a great 2-day trade for me. Really good profit on that. I made a few bucks trading Pinterest today, but I liquidated that position by the close as well. I got into this Alibaba. This was a tough trade, but also kind of gave an intraday double bottom and closed great. This Alibaba looks great to me, but we'll see. It needs to actually break up. It tried to give downside continuation through $78, and it just it wasn't able to do that. Double bottom, done the intraday, and worked your way back up. I want to see what my buddy Chris texted me on that again, because I agree with Chris's thought process. He said it reminds me of Meta at 90, 10x earnings, $50 billion in cash, huge buyback, and absolutely hated. And I totally agree with that thought process, though. I talked about these Chinese names in the morning a little bit when I was talking about oil also. I'm bullish on these things. I just think that sentiment in the Chinese stocks has become very poor as people are thinking that they're not getting like the great reopening economic wave in China that we experienced kind of in the U.S. and the EU. But at this point, I think these things are just so cheap, and I'm looking for ways to be able to be involved in them. So I kept some Alibaba overnight. I'm still involved in JD, but they need to prove themselves technically because the technicals are still kind of garbage. But it's an interesting, false breakdown kind of failure today, and a pretty good close on it. But now it's got to prove itself. It's got to get above $82 as a starting point, and then really work its way back up to that upper 80s, low 90 area. So that's all I got. Happy to take a look at what you guys are looking at. So scrolling up here in the VTF. All right, first I want to take a look at some of these earnings names real quick. All right, so what did we have? We had Salesforce come out. The Salesforce numbers look okay to me. Like, not, getting me very excited, but definitely not bad. Salesforce trading down from the close a little bit, which makes sense just because Salesforce has been on such a run into those numbers. It seems like people were expecting Salesforce to be like the next NVIDIA type of numbers here, and it's certainly not that exciting looking at this report. But the report looks okay though, and considering the stock just ripped from 175 to 120 since March, not trading great on an okay report kind of makes sense. I think we also got CrowdStrike. CrowdStrike's also had a really big move into it. Only trading, it's down huge, but it's only down into the 21 EMA off that, down 10.5% right now. I did not really look at the numbers. Let's see here. Pat says they beat on Rev. I'm seeing that. Beat on Q1 Rev. I don't see the rest of the numbers anywhere. They're probably in here somewhere and I'm just missing it. But anyway, they beat on Q1 Rev. I don't know what the rest of the numbers look like. Oh, adjusted EPS, 57 cents, estimate 50. I don't see guidance anywhere. That's Salesforce. That's CrowdStrike. We had Okta come out. Okta, not great. This is another one with a pretty big run into the report. The guidance looks like a beat there. I'm just looking at the numbers right now for the first time. Q2 revenue looks like a beat on guidance. Fiscal year adjusted EPS also looks like a huge beat. Gotta be missing something here. Fiscal year revenue looks like a beat. What am I missing on this Okta? They beat on Q1 revenue and they crushed Q1 adjusted EPS. I don't know. Got to be missing something on this Okta because those numbers look really solid to me. Granted, it's another one that's had a pretty big move into it. And then finally, were the AI numbers posted here in the VTF anywhere? I don't think I saw them. I'd be really curious to see them. But AI trading all over the place after hours. But as we're speaking, it's more or less trading where it started. I think I saw the options were pricing like a $9 move on this thing or something. That's what Josh was saying, so you never know. That's a big move on a $40 stock. I'm just kidding. We love Josh. Yeah, it's insane. $9.33 implied move, and the thing thus far has moved. It's down $1 from where it closed. Anyway, all right, let's hop into questions. Eddie Vick, I'm still in the bear tent. Look at all the AI tickers post to earnings. They're all down. Doesn't look great for tech for tomorrow. Yeah, we'll see. Are the Qs themselves trading down after hours? Yeah, the Qs are down 50 cents after hours. Technically, they're still in place, though. And I certainly understand the bear market thought process that can be made. All you got to do is read almost anything that any analyst says. But the technicals thus far have not confirmed it. The IWM remains a really big concern for me, though. Like, yeah, I was able to get this S&P breakout and this NASDAQ breakout without the IWM, which I didn't think was going to be possible. But it's still, there's still an anchor there, I think, to some degree on the market from this Russell. And watch out if the IWM really starts losing 170. That's when you'll start getting your technical confirmation for the people who have a bear thesis on this market. From Ben, hey Dio or Bill, could you go into more detail about how you read that 0 DTE chart that gets posted in the morning? Sure. So I see Bill responded here as well. Let me read what Bill said first, and then I will kind of give you my take or try to fill in some of the blanks. So Bill here is saying, to try and sum it up quickly, it's the cumulative amount of dealer delta hedging based on the previous day's option structure. It is specifically looking at 0 DTE options because that has the strongest gamma and will require the most rehedging. The chart is more accurate off of the open because it is the closest to what is the accurate option positioning. Soon as the positioning starts to change, the line could, in theory, change. You can use that chart to get a better expectation of what the options market makers will do based off positioning. If the flow is large, then it will affect the price action of normal buyers and sellers. Yeah, absolutely. So options trading in the market in general has exploded since COVID, and it's only been increased even further by the advent of all this 0 DTE and 1 DTE options that have come into place. And I am by no means an options expert. I do not trade options myself, but I understand the importance of market dynamics and how they affect the market. So even though I don't trade options, this is information that I want to be paying attention to. In the same way that, we pay attention to, like, I consider it like positioning and market dynamics to be a hugely important thing to pay attention to with trading. And for me personally, it's only something that I've really started to add into my game, if you will, over the course of the last 4 years or so, where I've really started looking at this in a lot more detail, where I like paying attention to, and these are things I never used to look at, the what's that chart called? That chart that Pat posts at the end of the morning note every day. The wow, I'm totally blanking. My brain is just still fried from that drive. The short-term tactical sentiment. That's what it's called. I really like paying attention to that short-term tactical sentiment. It gives me like a good idea on the very short term of, kind of extension and helps me from a game planning perspective. When that's up in that red zone, for me it means not necessarily to short, but that I shouldn't be buying. When it's down in that green zone, it doesn't necessarily mean to buy, but it means that I should not be shorting. That is going to be against me, especially for like the first half of the day. Will need some time or price correction to kind of satisfy that, and then maybe you get continuation, and that's how you can see like sometimes 2 or 3 days in a row in a really strong move where the market stays in that green zone on short-term tactical. But usually what we'll see is like on that day 2, the first half of the day is choppy, and then the second half of the day goes into an upside grind. I like paying attention to broader positioning, paying attention to notes on systematic buying and selling, which is a huge part of the market that comes from like the vol control universe, and you can just see that with the VIX. Like when the VIX is coming down, those algorithmic volatility style traders end up putting more and more market money into the market. They get more levered to the upside, and that's important to pay attention to as well, because at certain points on the upside it can become very, or on the downside it can become very extreme, and you go, oh wow, there's no one, who's left to buy, and if the market starts to come down it could be a big problem. And that was the note actually that Goldman had published a few weeks ago now when they were, came out with a bear call. They said that the systematic vol flows were basically like in the 1 percentile over the course of the last year. My counter to that was, well, over the course of the last year we've been in a bear market, so vol's been very high. I want to see what that looks like over the course of the last 10 years. So, but it's just a piece of information, because at the same time as we were seeing that like those algorithmic buyers were getting potentially like ahead of themselves on the upside, which could create more downside flows. Meaning if they have to unwind that, they don't have any bullets left for more buying, and if they have to unwind it, that could exacerbate selling. It was the complete opposite with hedge funds, right? If you look at the hedge fund data, they're like more net short than they've been at any point in the last 10 years or so. So they're probably getting their face ripped off in some of these QQQ positions. So that's actually countering information. I like to pay attention to that. Or right now, the data that we've seen, which is not, I'm not being bullish on oil specifically because of one data point. It's like a few things. But one data point that's an additional piece of information that I'm paying attention to is that there's like more bearish future bets on oil right now than there has been in the last, I don't know what it is, 10 years or something like that. The sentiment for oil has become extremely bearish. So, understanding positioning, understanding sentiment, I think are actually really important big picture layers of probability to pay attention for the market. And then the 0 DTE chart that Bill posts every day is just another piece of positioning information. And this piece of positioning information is based off of options, which, like I said before, have really just increased their importance with the market over the course of the last several years. And even as it's already been increasing since COVID hit, then we get this entire new product that hits with these 0 data expiration options, and they're kind of insane. I know some traders that trade them, and what is it? 60% of the options volume is 0 and 1 DTE options now at this point. If I've got that correct, 60%. So that's obviously going to be having an effect on the market, because what you got to remember about options, and again, I'm an equity trader, but what you got to remember about options is that they have like a larger effect on the market because they're leveraged products, right? So, and everyone should realize this, no matter how big or small you are of a trader, every time you buy or sell even a little 100 shares of stock, you actually influence the market. If you put a bid or an offer into the market, you actually influence the market. That's just the way the market works now. It's like a living, breathing organism. Your 100 shares that you put in the market, algorithms are reading that. They're making these HFT algorithms are making decisions based on things like depth of book, and they're seeing that extra 100 shares come in on the bid or the offer, and that actually is affecting the entire marketplace. And that's just with 100 shares of equity. Now you start to implement, options, and all of the immense amount of volume that's going off in options, and all this 0 DTE stuff especially, it's got big effects on marketplace dynamics. And we saw that note from, I think, JP Morgan like a week or so ago that was talking about how this market has been range bound, and that's been heavily affected by zero DTE stuff. So like I've traded a lot of market environments over the course of my career, and they're always a little bit unique from one another. But what do they say? History doesn't repeat it rhymes. But this has been a really interesting one here these last couple of months because I've traded range-bound markets before. Like I remember very specifically, probably the hardest year of my career to trade was 2015. 2015, we spent most of the year in like a very tight range. But unlike this last few months, which people have been complaining about, that was way worse because at least here we've got intraday volatility. The close-to-close volatility has been very low, and we can see that with the VIX, continuing to decline and holding beneath 20 at this point. But the intraday volatility has been very high. So what's causing this to happen? Well, a lot of it's actually based off this zero DTE stuff that's happening. People putting positions on in the morning has been causing a lot of that heavy early selling that we've been seeing on a lot of days, and then those positions kind of working towards expiration because they're going to expire by the end of the day no matter what, are creating a lot of those intraday reversals where day to day we're not getting a lot of volatility from close to close, but intraday there's been really, really big movements. And what I was saying 2 weeks ago when I did that afternoon meeting where I was like, guys, we got to recognize what the market environment is and we have to make adjustments to that new market environment. I've seen it over the course of my career a lot of times. The number one killer of entry-level traders who are just getting started in this business for the first time, is a failure to manage risk consistently and properly over time. But the number one killer of people who have previously been successful in markets, who have been doing this for, let's say, at least 3 or 5 years, and then all of a sudden are no longer successful, is because the market environment changes and they fail to adapt to that new market environment. And that's one of the things I've learned from my own trading, is there has to be a constant study of, well, what is this environment that we're in? Is it a trending environment? Is it a range-bound environment? Is it a volatile environment? Is it not a volatile environment? And now in this day and age of this current market environment that we find ourselves in, we are affected every day by the fact that I think 60% of option flow, which has now increased dramatically over the course of the last few years, even in general, is coming in the form of this zero DTE stuff. And what you have to remember, and this was a big thing also when we had the market bubble in like the beginning of 2021, and I remember there being a lot of chatter about, like, there was a SoftBank trader or whatever who was trying to pump up a lot of their stocks by, almost artificially squeezing the markets higher in some of those names, like basically using options, because somebody has to take the opposite side of every trade, and a lot of the time it's a market maker or a dealer that's coming in on the opposite side of the trade. They're actually even required to. Like, that's their job. They're required to come in on the other side of some of these trades. But they don't want risk, right? So if someone buys a call option and they have to sell that call option to them, then they need to hedge themselves by buying the underlying equity. And that buying and that hedging from these dealers that want to be able to stay neutral basically creates like this chart that Bill is providing us each day. And again, it's just based on the previous day's information, and it kind of just tells you, based on my understanding of overall market gamma, whether we can be basically looser, everything else held equal, if we'll be looser or tighter more or less on the day. So if you look at like today's chart, the black line is, I believe, like the previous day's closing price, right? So that's kind of that's our starting point more or less. I actually don't know what the green and red lines are. Bill, if maybe you're able to help me out on that. But like based off of yesterday, for today, we have like negative gamma here, where selling leads to more selling. So if this market is coming down, then these dealers are going to have to sell even more, and that selling leads to more selling. Sometimes it's the opposite. Sometimes you see to the left of that black line buying. So that tightens the market a little bit, right? So as the market comes down, buying will come in, which is like supportive flows from these dealers will come in that can create more of a, I don't want to call it a floor, but more of like a cushioning effect of the market on the downside. Whereas today is the opposite, right? Selling can lead to more selling. If the market starts selling, these folks are going to have to sell even more. And the opposite's true also. If buying comes in, then these folks are going to have to buy even more. So on a day like today, so first of all, when I'm looking at this, I really pay attention to, and I don't know if it's just a number that I've decided is important in my head. I pay attention to the spots where this becomes more or less than 50 million. And I think that that's where it begins to have a greater effect. And when it's closer to zero, then I think it's going to have a lesser effect. And obviously more is more and less is less. But I'm remembering that, like, I remembered that when we were selling early on in the day today, I was like, oh yeah, that 0 DTE chart this morning showed that if we start selling, I got to be careful. I can't just come in and place early bids and think that this market's going to turn around. It could. This is just one data set, one piece of information amongst, an expansive market that has so much going on and so many players that are involved in it. But when I'm looking at like a negative gamma situation where selling is going to lead to selling on the way down and buying is going to lead to buying on the way up, it tends to mean that I need to be even more careful on my counter trend stuff. So, yeah, Bill, if I said that right, let me know. I think you definitely know a little bit more than I do on all of it. But if I said anything wrong, please go ahead and correct me. But that's my understanding on everything. So cool. So there we go. And then from Kyle here, I think is the next thing that I'm seeing. When swinging something, if the stock was in an uptrend all day and you were trailing your stop with the stock you keep overnight, do you use the last trail as your stop or whatever you were swinging overnight before then trailing on the daily? So when I keep a position overnight, like what you're describing, I will no longer be trailing it on 5 or 15 minute charts, and the stop that I'm going to be using is my original stop. My original stop that I had on the trade. Meaning, if I'm keeping this stock overnight, I'm willing to give that amount of stock, which will usually, almost always, be less than 100% of my initial position. I've already booked some profit. I'm in a win-win. I'm going to make money on the trade no matter what. And I've got my original stop loss in because I don't think it's worth the risk of keeping it overnight if you're going to keep a super tight stop on it. I'm keeping it overnight because I did really well with this trade. I sold 70% of my position throughout the day, and on this remaining 30% of my position, something like that, I want to see, based on this beautiful looking daily chart, do I think I can get further continuation from it that can just really further maximize reward for me on the trade. But if I'm doing that, then I'm going to give it all the way back to my original stop, and at that point, I really only want to begin to trail based on an actual daily chart. Scrolling through the VTF here. Thank you, Scarlett, from YouTube, Chi. How do you stay concise? How do you stay concise when game planning various scenarios? I'm trying to write out all the scenarios, but get in so much detail that I get overwhelmed. That's a great question. That's a really good question. So game planning is, I think, a really big key to success in this business. It's one of the main drivers of success. It's what breeds consistency. It's how you tackle any psychological issues that we all face with our trading. Usually the best counter to bad psychology is good game planning. That's something I love to say. At the same time, I like to keep things as simple as I possibly can. I like to have a consistent set of game plans that I can almost apply onto any scenario. So, and you can adjust those over time, but base it based on what that market environment's currently looking like. And I know we discussed that about 2 weeks ago in that afternoon meeting, where maybe in this market environment, because we haven't been trending as much, we've been range bound more, you want to be doing more trimming and less trailing. And as opposed to a market environment like 2019, you want to be doing more trailing and less trimming, right? That's kind of how you're basing that game plan. But it's, how many shares do I have? How am I planning on covering my risk to make sure I'm going to win-win? And then what do I want to do with the remaining part of my stock? And then from there, there's only a couple answers. You trim or you trail, or a combination of both, right? So, and then there probably should be a little bit of a difference on if it's a with trend trade versus a counter trend trade. Counter trend trades should be less greedy because they inherently have a higher probability of failure in the long run. With trend trades, you should be more greedy because they inherently have a higher probability of potentially continuing forever. So it's, all right, you could say on my with trend game plan and my counter trend game plan, I'm going to sell 50% of my position at 1-to-1 to cover my risk, unless I deem it to be an A+ trade, and then I'll have a special game plan for A+ trades. But now after that, if it's a with trend trade on the other 50% of my position, 20% of it I will look to trim at certain risk reward increments and potentially rebuy that on the way back down for cash flow. And 30% of it I'm going to trail, and of that 30%, I will trail half on a 5-minute chart and half on a 15-minute chart. And then if it's a counter trend trade, same thing. Once I got my risk covered, I got the other 50% of my position, and based on that other 50% of my position, I'm looking to trim 40% of it and trail 10% of it, because again, it's a counter trend trade and has a higher probability of eventually failing. So that's how I would do it. And yeah, you can group it a little bit into a few categories: with trend, counter trend, make some adjustments based on the market environment, and then that's it. Don't make it too complicated. You should be able to have, I don't know, I would say less than 10 game plans that you develop, and you can take one of those 10 and apply it onto pretty much any scenario. From Jordan, what causes order imbalances? Algos, is there an extension trade there? Do you ever trade those? So order imbalances are relatively simple. So there is a type of order that you can put into the market. I don't ever use them. They're really more done by funds and mutual funds, funds that basically need to have the opening or closing price in their books, basically. So you can put in a market on close order. Let's say I put in 1,000 share market on close order to buy, and Jordan, you for Apple, and Jordan, you put in 1,000 share market on sell order, market on close order to sell for 500 shares. Let me just repeat that so I can make sure I said it right, because I might have jumbled my words. I'm putting in for Apple 1,000 share market on close order to buy. You for Apple, you are putting in a 500 share market on close order to sell. You need to sell, for whatever reason, for your fund, 500 shares of Apple, and you need the closing price. I need to buy, for whatever reason, for my fund, 1,000 shares of Apple, and I need the closing price. The difference is the imbalance. The difference of all of the market participants that utilize that order is the imbalance that comes in. And that does have an effect on the market. It has an effect on the market where if you've got these especially large imbalances, it's supply and demand, right? So if there's a really large buy imbalance, it'll cause that stock to uptick because everyone's showing, wow, there's so much demand here. In order to satisfy that demand, it has to go to a higher price, right? And at a higher price, maybe more market on sell orders will come in because it's a higher price, or there's just more liquidity on the way up that begins to satisfy those orders. I don't trade them. I know people that do. Almost everyone I know who does it at this point does it via algorithms, and it's basically an arbitrage trade, but that arbitrage trade has been arbed away because it's what happens by these algorithms. Like back in the day, I think before I started trading, or maybe when I started trading, I just didn't know about it. There were manual day traders who would sit there. especially on options expiration type days, end of month days. Russell Shuffle was always like the big one, where you get like really large order imbalances come in, and they would just sit there and they would figure out ways, and I don't exactly know how because I never did this, where they could filter out the biggest order imbalances, and they'd find those biggest order imbalances and see the biggest one and just buy stock. And as the stock moves up, because that big market unclosed order imbalance is there, that's to the buy side, the stock has to move up to satisfy that. They can sell into that and make a little bit of a profit for themselves. It happens so fast now that when those MOCs hit, it's like snap your thumb and you're immediately moved up or down to ARB for that. There probably is still some room for profitability in the really big imbalances, but again, it's people at this point who are using computers for that to take advantage of it. And we have some of those people even at T3. We have people who have algorithms at T3 that are specific to trading order imbalances. I don't do it. But appreciate the question. I don't think that there's anything for us to do there, but it's important. It's information. Like, I don't trade when Pat gives us an early look at the broader market buy or sell imbalance is going to be coming in, but I tend to find that whenever it's in excess of $1 billion in either direction, that it moves the market. From Dave S. Would lack of Russell participation make sense in a world where this rally is based on funds having to chase the NASDAQ stock instead of an actual value increase from those said stocks? For example, my fund has to own at least a percentage of NVIDIA and Apple and Microsoft, and I was light on my positioning before the rally for whatever reason, and now I have to chase it. So what you're describing there is what's called window dressing, and it's absolutely a thing that funds have to do, and that's especially so like at the end of the year and the end of the quarter, where they need to be able to show their investors that they were involved in the right names, because the most important thing for a hedge fund manager is to maintain and raise assets, not necessarily to make a profit. I don't think that this degree of outperformance from the NASDAQ could be that. I think that there are real players out there who think that AI is the next internet, bigger than the next internet, and they need to be involved in these names. They want to be involved in these names because they want to be able to participate in that. And that's, of course, even squeezing other funds that might be short them even further. So I think that's true to a degree, but I also think that there's a different narrative that's actually going on. The question is whether or not they're right, and the jury's out on that. Obviously, some of this AI stuff that I've seen is really pretty impressive, but does it justify, I don't know, $300 billion market cap increase in NVIDIA or whatever it is over the course of just a few days? I don't know. I genuinely don't know. Maybe. We'll see. We'll see. Who knows what the world's going to look like in 10 years. Yeah, so you're saying that you're just having trouble with the divergence between the indices at the moment. Me too. That's been the hardest thing for me about this market, and I always keep it real with you guys. I got no problem telling you when I'm doing poorly, so I don't mind telling you when I'm doing well. Outside of that SVB loss, I'd be having like the best year of my career. I've been trading extremely well, and I'm really happy with myself. But I've still been really struggling on some of these days to wrap my head around and rectify the differences on these indices, because I don't remember ever seeing it like this, really. I don't remember ever seeing these deviations that are as big as they are when you're looking at the IWM versus the Qs. And that makes sense, right? Because when we see the data on, I think someone yesterday or today in the morning posted a chart that showed the difference between like the biggest market cap stocks and everybody else. I don't exactly remember what it was, but it showed that this is the biggest differences that we've seen basically since the tech bubble. I just would be really careful as well with charts like that, because I don't think that this necessarily has to resolve in the same way that the tech bubble resolved. Correlation is not causation and all that fun stuff. But you look at all those charts, you look at all that data, and it's like, okay, No wonder I've never seen anything like this before to this degree. But I mean, that's what I love about markets personally. There's always something new. There's always something new to learn. There's always something new to figure out. You know, we're gonna see how this plays out. A brand new environment. I don't know. You know, I told you guys this morning, and I told you guys in the afternoon meeting today, the bull and the bear case. Right? The bear case is we got a blow off top here in the NASDAQ. The S&P has a false breakout above 4,200, and the IWM breaks down and gets below 170. The bull case is AI is real. The Qs go sideways up here. They correct. The S&P holds above 4,200. They confirm the breakout. Eventually, the IWM starts catching up. I don't see why, if AI is going to be as revolutionary as the biggest bulls think it will be, why it's limited to tech. Honestly, like I think JP Morgan has discussed about how they're using AI for portfolio decisions now in financial advisory and things like that. So, you know, it could potentially have positive influences everywhere, but we'll see. I'm sure, like with all new technologies, it creates winners and losers. Where's that AI now? Speaking of AI, down $6. Just looking at the numbers. From Dave S. Trading in 0 day to expiration options comprised roughly 22% of trading volume in S&P 500 linked options trading on SIBO at the start of 2022, but that figure exploded to more than 40% at the beginning of 2023. Thank you for that. Bill giving us more information as well. I'll review that in a bit. Red and green lines are a different thing. Worth looking and watching. Cool. From Kyle, when you mentioned the 2015 market being range bound near the whole year, did you find yourself trading the market less and focus more on strategies around earnings and news plays? That's what we're trying to do. I mean, you know, it's adapting as well, right, to the market. I'm better in 2023 with 8 additional years of experience at adapting to new market environments than I was in 2015. 2013 and 2014 were really strong years for the market, and it wasn't until like 2013, 2014 that I started swing trading at all. The first 3 years of my career at T3, I was 100% a day trader. I never kept positions overnight. The longer I've been in the business, the longer my time hold has become. So I remember in the beginning of 2015 watching my swing P&L go up and then come all the way back down and then go up and then come all the way back down, like exactly tracing the market's range. And it took me a while to make adjustments. I think I remember struggling a little bit, as most people did. I remember 2015 just being really tough, struggling a little bit, especially in the beginning of that year. It was like I would make the money and then I would give the money back, and I wasn't like losing money, but I wasn't really making it either. And then I started to adjust a little bit, and was able to do a little bit better on the intraday stuff. But there was no intraday volatility, so that wasn't great either. And then eventually I just survived till August. And I think it was August 24th, 2015. That's one of the craziest days I've ever seen. And it was that little blip in like August to September that I think I more or less was able to kind of make my year on. So, but yeah, again, hard to remember everything perfectly from 8 years ago, but I would assume that we were focusing a little bit more on stuff that was in play. But I remember my old partner, Chris Shore, at the time, who at the time was a much better trader than I was, also just getting really frustrated at certain points in 2015. He's one of the better traders I've ever really worked with. He was just getting really frustrated in 2015, even on stuff that was in play. I remember him just like making like a lot of money on some of these names sometimes, and then giving it back. Thanks, Bill. Okay, cool. Looks like I got through all the questions. So, good afternoon meeting today, guys. Appreciate all those questions. Like I said yesterday, it's what makes us better. I was about to say I'm glad to be back in New York City, but I don't want to lie. I'm glad to have the good technology here a little bit. I'm glad to be able to show my face a little bit in the afternoon meeting again. I bought that new computer as well that I said I was going to buy as soon as I got back to New York. So I got a new computer also. So hopefully next time I'm in Idaho, things are working even better because that computer was starting to give me some issues. I haven't had any pizza yet because I just got back last night, but it's definitely happening soon. Stromboli's in the East Village. I'll be there. Have a great night, everybody. See you then.